Good afternoon. It's a crazy week this week. We had the inauguration just yesterday. We see the markets kind of continue to climb, so we'll discuss why. Plus, we'll share some thoughts as to what to expect from the Fed meeting coming up here next week. My name is Brandon Steele. I'm a financial advisor with Mainsail Financial Group just here in Bellevue. Every week, we want to bring kind of the market news and data in a quick, digestible video to you. That way you can kind of sift through all the noise and really focus on what's important. If this is helpful, please do subscribe, please do follow us, and that way we can make sure to come to you each and every week. This week was a short week here with the holiday on Monday. We were still in, but if you had Monday off, I hope you're able to kind of take it off and enjoy, maybe get outside. It's been pretty nice so far all week here this week. So hopefully you're able to enjoy the holiday and gearing up for a nice weekend coming up here as well. So as I mentioned, markets were closed on Monday, so we had a little shorter week coming into this kind of third week here in January. But a lot has happened since, and a lot ahead of us in the week to come. So on Wednesday, we had the Biden inauguration, and throughout the week, Wednesday included, we actually saw kind of this pop in the markets. We saw the markets kind of continue to climb. And I think what we're really seeing is this expectation of more stimulus to come. In fact, fast forward to today on Thursday, we got some news that that they're working to put together the stimulus package. I think it's about $1.9 trillion in total. And so I think that's where we're seeing a lot of the markets kind of lift up is in expectations of a little more stimulus to come. Obviously, with the inauguration, it was great to see kind of a peaceful event. It's just like, it seems like no matter what's going on in the world, it's just been crazy the last year and a half or so. So it was good to see that. And again, it is depending on what shakes out of this stimulus package is really going to shape some of what's ahead. I think a lot of the stimulus based on the 1.9 trillion has kind of been priced in to some degree into the markets already. But if it ends up being more than expected or less, we may see a little bit of adjustment based on what actually comes to fruition. But I do think that that's why we're kind of seeing this lift up here continue as we move into 2021, back near all-time highs again, and just kind of keeps on marching. Today we had initial jobless claims come out. So we had another 900,000 jobs lost again this week. So, again, I think I was just talking to somebody about this actually a little bit ago. There's such a disconnect right now between the markets and the economy. And it's been this way really since the pandemic started. And it's important to understand the difference between the two. The economy is still struggling quite a bit, but the markets just keep running. And it's a lot based on, the inflation, the interest rates that we talk about time and time again, a lot based on some of the stimulus going into the markets, all that good stuff. So just keep that in mind that, we're getting this pretty bad news actually in the economy when we talk about jobs and stuff like that. But the markets just kind of continue to keep going. And truthfully, if this continues, it's possible that goes for a little while still. However, all things, all that does add up. And so it's important to also play a little risk management within there as well. As we look into next week's going to be pretty big. Next week, we have consumer confidence. And more importantly, we have the Fed meeting on Wednesday, I believe it is. So Powell will be sharing more. Just late last week, Powell came out and said that there are no intentions to tighten monetary policy, no intentions to pare back the bond buying program anytime soon. I believe he said that the time now is not the time, I believe was the quote. So it's really interesting because for those who follow us a little closely, just a couple weeks ago, some of the other Fed members of the Fed had discussed the idea of starting to pare back on some of that stuff. Now here's Chairman Powell saying that is not the intention and that will not happen soon. So get ready because Wednesday is going to really start to tell a story when they meet, and then we hear Fed Chair Powell share some of the thoughts that come out of that meeting. This is like one of the catalysts behind all the growth that we've seen is the way that the Fed has handled this, keeping interest rates extremely low, buying bonds directly. All these different programs have really helped to keep the markets, not keep them, I should say, propel them forward. And so if there is this idea of starting to pull back on some of that, you might imagine the markets may not like that. And so it'll be really interesting to see how this all shakes out, not only next week, but in the months ahead. And I think it's going to be really important for them to do that carefully. If they rip that Band-Aid off, which I don't expect this time, by the way, but if they keep pushing this off and then finally decide to tell us that, that they're slowing down on that stuff, it's going to have a big impact on the markets. And so it'll be interesting to see how they slowly kind of introduce that and make sure that the markets don't have a fit. So pay attention on Wednesday next week to the Fed, and really anytime the Fed's talking, that is a big catalyst in what we're seeing. We also have income and spending next week. So although the jobs numbers, have been terrible, it'll be really interesting to see how the income and the spending numbers look in the week ahead here too. With that, we'll go ahead and jump into the question of the week. Again, if you have any questions for us, whether it's the question of the week or you would like us to address something, or you have questions on anything we've covered, whether it's the Fed or the inauguration or anything like that, you can text us 425-502-7693, or you can email us directly as well, info@mainsailfg.com. So the question of the week came from a client, and the question is, what is the relationship between interest rates and the impact to bonds? Just since the beginning of the year, it's been amazing to watch interest rates. They have just spiked. It may not seem like a whole lot in terms of the percentage that they move, but when you're coming from such a low floor, that little gap in percentage actually is a huge difference when we talk about the difference in the rates, not just the actual 0.5 to 1, for instance, but the actual percentage change that's 50%, right? So the question came up, what does that mean to my bond portfolio? And the reason this is so important is because, especially for those getting closer to or in retirement, we've all been told to use bonds to help provide income and, kind of provide some stability. Bonds are still important. Don't take this the wrong way, but it's important to understand how interest rates play a role in your bond prices, because think about a bond as an instrument of debt, right? When you buy a bond, you're essentially loaning somebody, some entity, some government, some corporation money. And for that, they pay you a certain percent of interest each year or each quarter, whatever it might be, right? If interest rates rise and there is now a new, bigger, faster, stronger machine out there, and you still hold that old machine paying, let's say, 1% as opposed to 3%, do you think you'll get more or less if you went to go try and sell it? Right? The answer might be less. So as interest rates rise, bond prices actually come down. And that's really important to understand, because a lot of folks have a lot of their assets in bonds, and it's not to say avoid them, but it's important to know what you hold and what the impact of rising interest rates might be on your bond portfolio, because that is meant to be kind of the stable piece of this. So really pay attention to that. We saw, we've been talking about it for a while, but we really saw a reaction to it in the last couple of weeks here as interest rates just spiked like crazy there pretty quickly. So pay attention to that. If you have any questions on what that means, or when I say what to pay attention to within those bond portfolios, don't hesitate to reach out. We'd be happy to share a little bit more detail on what exactly we're referring to. But it is important to understand what you actually hold as far as the bonds and the relationship between interest rates and how that affects your portfolio. So thank you as always for joining us here this week. We'll see you the same place, same time next Thursday at 3 p.m. Until then, feel free to reach out if you have any questions, and we'll see you next week.